So let's attack the 4% rule part of his question, because that was the very first part of it. He said listening to our show, so I'm sure he's heard us talk about the 4% rule and the fact that it is a rule of dumb and it works until it doesn't. But let's define what that is for people who are listening or watching and have not heard us talk about that, and then we're going to give a real-world example of how that might play out. So the bottom line here is the 4% rule is kind of attached to the asset allocation strategy that has been in place for a long time in the financial services industry. And here's the way it works, is basically at retirement, you need a balanced portfolio. You don't need to be all in equities, and we would agree with that part. But the static asset allocation model says 60% of your assets in stocks or stock instruments like mutual funds or ETFs, and 40% in fixed income or bonds, okay? So the concept here is a balanced portfolio. The fixed income will soften the blow of the volatility in the stock component of it, and you'll rock along and be okay and never run out of money if you pull about 4% out of that portfolio. Well, what we saw in 2022 was it's very possible for that 60-40 portfolio to nosedive, right?
Especially when rates are up.
Yeah, so rates rose in 2022, which put downward pressure on bond prices, and it was one of the worst years on record for the 60-40 portfolio. So let's take a modified version of that in any given year and put some numbers behind it. So if your initial portfolio were $1 million, let's say, and the first year of retirement, you decide you're going to adhere to this rule of 60-40 and would take out 4% of your portfolio every year. So that would be $40,000. But what if the market dropped? Let's say your $1 million went to $800,000. Now that's a severe example, but that's what happened. That's about what happened in 2022 in a 60-40 portfolio as measured by the indexes there, the stock index and the bond index. So you would enter year two with $800,000 due to the market decline, which, oh, by the way, you took out $40,000. So let's say the total difference was going from $1 million to $800,000. If you have to make a decision in year two, what are you going to make? Are you going to take the same 4%? Because it's the 4% rule. That is your strategy. Well, if you apply that to your income formula, well, now you have to take a pay cut, right? Because 4% of $800,000 is $32,000 per year. And most people are not going to do that, Chad.
No, because there's not many times that we've seen in history that prices go down.
Right. So you don't want to take $32,000. So most people are going to continue to take the 40 instead of 32, and now you're withdrawing 5% in this example instead of 4. You've already destroyed the 4% rule, and your money could run out much earlier at that rate. So that doesn't work, and we don't plan with that in mind. So what do we do, Chad? Let's talk through how we take that volatility component off of the money we're taking out right now.
Well, and we've talked about it several times here, the market volatility, the inflation risk, and longevity. And so therefore that we have to have a strategy for that, and we call that the bucketing strategy, the income for life model. And so basically we're breaking it down into time segments that we're going to need those funds over your retirement lifetime. And so, therefore, the very first segment, we do not want that fluctuating with the market. So we need to be very conservative with those investments. And then as those segments are time slotted out for the future, we need to be more aggressive to help increase that income over time for inflation. So those clients that are coming in and we're doing reviews on right now that we've got them in this strategy, hey, listen, yeah, last year market was down pretty, significant amount. Those later buckets were down, but their income hasn't changed. And so that is allowing us to be proactive instead of reactive to when we have some downturns in the market.